All right, good morning. Yeah, hey, it's 7:01. Welcome to QuantBox Live, where we get our global macro on. Just want to remind you that we have an upcoming summer school that's just starting in a few days, and part of this will be taking what's in QuantBox and putting into a trade plan, but even more important than that, actually pulling the trigger. You're going to get very, very good, and not just planning trades, but pulling the trigger. Do it again, do it again, do it again, do it again. So we're only 11 days away. So what are you waiting for? It's time to get going. This is a very, very, very practical program, much more than a series of lectures. Actually getting out there and hitting the ball, so to speak. So with that being said, let's get on with it. Let's uncover the global macroeconomic trends. QuantBox has been telling us for several days, if not a couple of weeks, right? It's been telling you, get ready. We're losing some of that enthusiasm. Well, maybe that'll come back tomorrow. Well, we'll find out. So let's go through and take a look at all the different screens. We'll look at our dashboard and get an update of what's going around the world. We'll focus on our hit list. And we're going to look at things like the bid call ratio, or we're going to look at the money market. And then we can drill in to potential investments. On the weekly, we like to look at, what's going on with institutional investors. We like to look at what's going on with the central banks and where they're positioning for inflation and interest rate, right? And then we like to plot that 18 months in advance. And we like to look at a basket of of asset classes, and from that pull out the correlation so we can uncover the underlying intrinsic trend. Hey man, it's $80 a trade like a professional. You want some confidence in your trading because you are trading reality and this is how you organize your setups? Yeah, $80 is not a lot. If you're trading like a small business, it's simply a business expense. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. Okay, let's go to the pro. Let's log in and then go to the pro. Loading, loading, loading. Okay, yields are up significant. So we had another auction yesterday, and prices were low. Pretty simple. Prices were low, which means the implied yield is up. Okay, so that's not so good. Remember, I want this to be going the other way. Well, tomorrow everything could change. That's all. Yeah, Jim's like demand was soft. Well, and that's how the media always covers it, right? Like there was terrible demand. No, they just wanted a lower price. It's only price, right? So anyways, yeah, that's the price that they were willing to pay. And because what's going on is people are like, well, if the Fed's not going to cut, I'm going to have to be compensated for that. That's all, right? That's all. That's all it is. But there's plenty of demand, just not at a good price to the seller, but to a fair price for a buyer. And and usually what it is too, in particular with treasuries and stuff, it's just math. So if the treasury market, the actual buyers, don't think the Fed's going to cut, well, then they're going to put that into their math and it's going to spit out a fair price. And the fair price was low, which makes the yield look high. And I'm like, yeah, that makes sense because They don't expect the Fed to cut higher for longer. So yeah. So that's that's I always pick on the media for that because I think that's all that's going on is, well, it wasn't really soft. They just don't think the Fed's going to cut, so that's the fair price. But anywho, it'll be a terrible day when it truly is like nobody shows up to lend money to the government, like at all at any price. Because there was a time, like if you remember, Greece, remember that, Jim? Greece was paying 20% and nobody would lend the money. They're like, it didn't matter. We don't care. The 20% is not good enough. Um, so we're not there yet. But sometimes I think that's what the media is trying to say, like, oh my God, demand is soft. It's our debt. It's our level of debt. No, it's the price of the debt. But anyways, I'm not saying you're wrong. But yeah. All right. Oil back down. This is interesting. Did you see it? Are you watching it? You see the price? Okay. Burns says, is there any chance the Fed won't cut? Well, for sure. But let's change that. For example, what do we know? We know the last summary of economic projections, they said 3. We know that to be truth. So I guess I can just bring that up since we're talking about that. All right. You guys are diving right into it. All right. So you go to the central bank. Boop, 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 boop. Great. Pull up the US economy. Okay. All right. So what you can do, Bernd, is you look at where the Fed thought inflation would be versus where it is actually now. And we get another look tomorrow. And based on that, the path of interest rates in the future. Again, this is all according to the Fed's plan. This is not QuantBox calculating and guessing. This is the Fed's business plan. And based on that, this is the shape of the future yield curve. And they have a cut coming in the summary of economic projections. Now, it's almost certainly not wrong, but it almost certainly will be updated because the inflation level is not what the Fed thought it would be. So therefore, the shape of this needs to change. Is there any chance the Fed won't cut? Well, the Fed will likely move this dot up. And so the big debate is, will the new summary of economic projections in a few weeks, couple of weeks, will it show 2 cuts this year or 1? Well, we don't know. They haven't done the summary of economic projections yet. So anybody saying anything is guessing. Now, maybe that's your job to guess. Okay, maybe. But that is the debate. Will the new summary of economic projections say 2 or 3? And you should be analyzing where inflation was thought to be and where it is now. Okay. Then you mentioned, right? So is there any chance? Yeah, well, the summary of economic projections is not likely to say no cuts. Because remember, there's a lot of voting people there. I don't think everyone would vote that extreme. I mean, it makes sense. I'm not saying it doesn't make sense, but will you get a council, to all be extreme and say no cuts at all? No, 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 that ain't going to happen. Now, it may end up happening, but there's a lot of time for those, votes, if you will, a lot of time for the data to come out. So that I would say the chance of the SCP in June showing zero cuts is nearly zero. And I think the worst case scenario is it comes out 1.5 cuts, which means we don't learn anything. Um, and then in reality, burned the outcome of this new summary of economic projections, which QuantBox will display for us visually, which is nice to see. Um, oh, I lost my train of thought. The outcome. Oh, will be it's either going to be September, December. There's your 2 cuts. Or it'll be December. And what I said, not in June or January, but I think a few months ago, maybe the beginning, yeah, a few months ago, anyways. I said I thought there would be 3, and if it was 3, they would have to put it every other meeting on a schedule. And I gave an example of a CEO that sells his or her own stocks. You have to put it on a schedule to show that you're sort of benign, you're not timing your trades because that would be insider trading. So you would put a schedule and say, every quarter sell, 10,000 of my shares at any whatever the market price is, so that that person can earn the money, but still be impartial, right? And so the Fed would go every other meeting to show that there's a schedule to this to tippy toe around the election. This is again what I said quite a few months ago. Um, and so if it's not going to be 3, it'll be 2 or 1. Then it's the same idea, I think. September, not November, December. Okay. Or we start not in the November meeting, but the December meeting. And that would be the first cut then. Because remember, the Fed meeting is the day after the election. So anyways, right. Well, Burn, so like for example, does QuantBox show you inflation in the United States? Yeah, in many, many, many places, right? So you could just do a comparative analysis. Well, Byrne says so they want to wait after the election. Yes, although they in the last press conference, Jay Powell said he doesn't care. Sure, maybe that's true. Um, but it's more like the they don't want to be seen, not just the political side, but they don't want to be seen as sort of responding to the demands of the stock market investors kind of thing. So it's more like just in general, when they decide the Fed funds rate is too restrictive and they would like to normalize, then they would simply put it on a schedule of normalization. And the debate is, because there's 2 debates, right? What is the new fair value of like interest rates, the neutral level? They want to be slightly above the neutral level. So to get to that, you need to know the neutral level. So what's the neutral level? What's a slightly restrictive policy? So all of this is called R star. You're always trying to figure this out um, when in economics, right? And so the actual rate where we're trying to get to is one thing, and then how fast do you want to cut? Well, if the economy, and this is again, I think this is where a lot of media mixes things up, because when does the Fed usually cut interest rates? When things are terrible. Okay, when things are terrible, the economy is falling off a cliff. So they slash and burn interest rates, right? That's not what's going to happen. So everyone's like, "Oh my God! So if the Fed cuts, it's the end of the world." No, 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 no. So again, instead of having these, let's say irregular meetings where in one meeting they cut by 2 basis points, and then the next meeting they cut again, and then the next meeting they cut again, and they're just like every meeting they're cutting. That's not likely to happen. They're normalizing. Now, we usually are not in a situation where the central bank has to do this, but this is where we are. So they'll just slowly normalize. They're reducing, not because they have to save the economy, but just it's too high. That's all. It's just really, and what it does is it messes things up when it's too high. So they'll cut it back slowly and deliberately and impartially until they feel like it's on balance a fair rate. That's all. R star. So it won't be dramatic. Okay. So what you should be doing now to try to create um, a view of what you think the Fed will do, you would take what the Fed has told us, compare it to the results that we actually have now, right? Your comparative analysis. And then you could talk intelligently about, you could say, well, the Fed thought we'd be at 2.7 by now, whatever, or 3.1. And you can say, but we're not there. Okay. And that's what the Fed needed to see for their first cut. So, like, we've known this for a very long time that there's a cut coming here. Okay. June. Okay. This is what we've known for a very, very long time because it's in the summary of economic projections. It's what the Fed told us. This will be revised. This is very unlikely. And so it'll probably have a different shape now. And realistically, this would come up, and then this cut would remain, and then this would come up, and then there'd be a cut here. Or, okay, green, 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 cut, or green, green, cut. Okay. Now, the second thing that you could do, and this is why we track the money market, for example. Um, Let me zoom in just so we can see this, and then I'll show you what you can do. Okay, this shows us risk off. This is the money market. I've introduced this tool, what, 2 weeks ago? This tells you the stock market's likely to fall. Okay, these traders are at least 10 times bigger than the entire stock market. And by 10 times bigger, it might be 40 times bigger, which is 4,000% more money. Like, it's huge, right? Way bigger. And we've known now for quite a while, okay, that it's risk off. Okay. How does this impact the stock market? Stock market down. Oops. Okay. Stock market down. And very clearly risk off. Okay. Now, how this impacts other markets. Okay. That's the money market. Then you can go to the CME group, and you can see how this impacts the not the money market. Okay, that's like the most liquid um, public market. This is private lending between banks. Okay, private lending between banks. And we're looking at the price of short-term loans. So if you were Bank of America lending Wells Fargo some money, in this particular case, $100, what'll happen is, right, they lend them $94.67. And when the loan is due and they have to pay the $100 back or pay the money back, they have to pay $100 back. Okay. So you borrow 100 and you get 95. Okay. So, right. So you're like, well, that's 5% or just five and something. Well, yeah, yeah, maybe. All right. But so you can figure out there's a reverse implied interest rate. And now by looking at the price, and this is what we're talking about with the auctions, very, very similar. The government was loaning out money or borrowing money, I should say. Okay, borrowing money. So think of it this way: the government is like, "Hey, Burned, I want to borrow $100 from you." Okay, how much money would you give me if I gave you $100 in the future? Right? Oh, I'll give you $95 today for $100 in the future, right? You're not talking about an interest rate, you're talking about a price. In this case, this is happening bank to bank. When you do it, when you buy a treasury, you're loaning the government money. And so, anyways, so all these markets are linked. Okay, they're all linked. They're all related. And right now, the June meeting, okay, nobody says there's a cut. Look, 1.1 says the Fed's going to raise interest rates. Okay. But nobody negotiated a contract, a bank to bank contract. Okay. This is not a survey. Nobody negotiated a contract based on lower interest rates in June. So there's not a chance at all the Fed cuts. Zero. That changed. That used to be much higher. Now, what I've taught everyone in the past, okay, is if there were cuts and then the cuts are moving out, what I say is everything's moving to the right. Okay. When you see stuff to the left, like 5.0 to 5.25, that means there's a cut. Things are moving to the left. And when things are moving to the left, the dollar gets weak. If they're going the other way, in this case, I know it. I know it has. In fact, I think I could probably prove it. A month ago, 10% of the market priced in a cut. Now it's zero. So it went from a 10% cut to a 0% cut. That's moving to the right, and that's when the dollar typically gets strong. Okay, or you can look at it as risk off. Now, if you go back 3 months ago, it was probably 60%. And if you go back, the beginning of the year, it was 100%. So now it's zero. Okay, it went from 100% to zero. All right. So are they going to cut in July? Some people think maybe. That's an odd month for a cut. So I'd say no. What about September? Okay, now you see everything moving to the left. So right, we're currently 5.25, 5.5. 43% of the market thinks there's going to be one cut by September, and some think there'll be two cuts by September. So, what are the chances the Fed cuts? Is what Burns is asking. I'm like, well, there's a 48.7% chance that we'll have a cut in September. Okay. Then I think we'd be paused here. So I don't agree with these guys. Okay. I think we'd be paused here. And that's about, 45% of the market is with that. So I'd say, wow, there's a 62% chance, 618, isn't that beautiful? 62% chance that by November we'll cut. Yeah, yeah. By November. But in November, I'd say, almost certainly no cut, in my opinion. And then you look at this, and now 80% chance there's at least one cut by December. Okay. But another 30, maybe include these guys in there, 40, right? Not quite a 40% chance of two cuts, 80% chance of one cut. So we're kind of 50-50 on the two. And there you can derive a calculation of 1.5 cuts by the end of the year. You're like 1.5. Yeah. But remember, based on contracts that are being negotiated right now, not survey, not economic analysis. That's all assumed. It's assumed that these investors know all this because they're the smartest, biggest money in the world. So they're figuring out the future interest rates and then negotiating it with other smart money. So, those are neat tools. Those are neat tools. Uh, this is a very much like what's happening today type thing. Burns says they're actual contracts being negotiated and not expectations. Well, to answer the first one, are they actual contracts? Yes. Okay. The second one is, are they not just expectations? Well, they are expectations and they're negotiating based on their expectations. But yeah, it's not a sample survey or something. It's hard money being traded, moved from one bank to another bank. Yeah. Right. But think of it like you're negotiating to buy a house and you think the market's going to tank in the very near future. Okay, you could, based on your expectations, put in any price, any bid you want. But if you think the market is going to tank, you're like, "Well, I really like this house, and I'm really glad it's on the market." And you meet with the buyer or the seller, and you're like, "Hey, I do want to buy it, but honestly, the stock or the real estate market looks like it's going to tank because of X, Y, and Z, and it could be, brutal 5 years." So I'm going to put in. This is again you talking to the seller. You can say, "Well, based on my expectations." The market coming down, I'm going to put in a low offer. Please don't be insulted by it. Just realize what I'm doing is I really think there's a lot of risk to the downside. Okay. Good. Now, someone else might buy it at the higher price. That's fine. But if no one shows up and the market does tank, then that seller's either way is going to have to lower price, right? So it's all about expectations of the future for sure, but you're still putting in offers and bids and accepting. You can't force other people to not pay higher price than you would pay. But nonetheless, if no one shows up to buy, there's nothing the seller can do because there's no one that'll pay that price. Right? So, anyways, when I look at this is a much quicker synopsis than looking at the Fed funds rate of like what percentage do we think, what percentage of the market, excuse me, thinks we'll have a certain interest rate in the future, right? This is happening like now, like right now. We're not talking about what might happen in 3 or 4 or 5 months. This is what's happening right now in a very deep, very, 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 very liquid market. This is a massive indicator. and it's very sensitive. This updates every day. Okay. And what we're seeing here, and this might be helpful, not just that it's going up. Okay. Let me get my drawing tool if I may. I'm not sure if it'll pop up or not. Oh, yeah, it did. Good. All right. Let me move this over. When you focus at this part here, if you go back into the calendar, I think it was what, 1 year, 2 year. I think there was a 7-year auction. Very strange, 7, but whatever. There might have been a 5-year auction in there. So in this period, which this rose, okay, the government was selling a lot. Okay, that's it. They're selling. And when you're selling a lot, what happens to prices? Prices fall. So you could look at this and say, the market thinks it's the end of the world. Well, that might be the case. Yeah, yeah, that might be the case. Or maybe it's just the government, because remember, treasuries is just government. The government sold a boatload, uh, right, and pushed prices down. And we're just going to wait and for them to stop, and then prices can recover. That's all. Could be just what's on the calendar. Could be, you know, what's the right word? It's not economic. It's not technical, but it's a just sort of a response to what's actually happening to the market. You could look at that and say, well, there's a lot of supply. Again, what Jim pointed to earlier is the media says, "Oh, demand is terrible. Nobody's buying this stuff." You're like, no, 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 no. There's just a lot of supply. There was a lot sold. So I'd look at it the other way. It's like, okay, the government is running a massive surplus and they're dumping a huge amount of treasuries. They're borrowing money like crazy. But every single treasury gets sold, right? Yeah, right. Every single one of them gets sold. It's just a price that has to get negotiated. So, anyways, I look at this as when this is going up, the supply, the borrowing, right? The government borrowing is going up, and that's not good. And that'll bring the stock market down. Yeah. Anyways, cool, right? Cool beans, right? Yeah. Well, let's get back. Hang on. Let's get back to this. A little bit of risk off. Okay. Bitcoin might be an opportunity. Euro dollar could be an opportunity. S&P 500 technically. So now the price is down, but did you see the daily 21? Did you see the roll reversal? Are you looking at the charts? So there might be an opportunity there. Okay. Looks like everything sold off. So the bond market down, the commodity market down, the stock market down. Euro dollar down, Bitcoin down, right? Yeah. Do you think we're taking risk off while we wait for PCE tomorrow? Could be, right? Ooh, that yeah. All right. So here's that, and then here's the put call ratio. So this is the money market. This is treasuries, the government borrowing over here, and the market's willing, to pay a low price or a high price. So that'll show us risk on or risk off. But also over here, this is what the options traders are doing. Remember, the options people don't talk to the to the treasury people. And even treasury people don't talk to corporate bond people. you know, like all these constituencies, they don't talk to each other. They're just doing what they want to do, and there's some risk on. So we're still at that 8-8 level, and so these guys are buyers. We could look at some other markets, and not so much. So the longer term people went from a 4 to a 2. And then shorter term, this was flat, now is a -3. This is a -2 to already today. Okay, this is definitely a cautionary tale. Okay, definitely a cautionary tale. Copper and silver down, platinum flat. Let's look at commodities. General oil flat, gold flat, platinum down a bit, silver and oil crushed. Those might be opportunities, but right now they're pulling poor scores. Okay. Small stocks, small businesses getting crushed. Why? The Fed not going to cut anytime soon. It hurts the Russell the most. Okay. Convexity, which means they're more sensitive to interest rate changes or not cuts than everybody else. Japanese stock market down, Dow is down, S&P 500 is down, Nasdaq is down, DAX is flat, FTSE is flat, and yields are up. So, yeah, when yields are up, stock market's down. Hmm. What is that doing there? That's surprising. It's kind of like waking up in Vegas and finding a tattoo on your arm. Hey, what is that? Oh no. Yeah. What is that? I wonder why that is there. What were they doing? Okay. Anyways, majors. This looks risk on to me the way that the dollar's playing. So dollar slightly weak. Kiwi very weak, even weaker than the dollar. But then like this is flat. But look at this dollar weak, dollar weak. Interesting. That's a bit of risk on. Right. So we got some GDP today. Early stuff. Weekly jobless claims. This could actually be interesting. You know, there's a bit of sensitivity to that. And I think we're working on some interesting things on QuantBox for you. And like, for example, we have more than this, but um, that's not the one. Here we go. So here's where we're tracking, huh? We're trying to show the change, and if this is rising, then it's something that the Fed is watching. This the only reason it's there. Um, I guess maybe I should just unlock some of the other stuff. I think the other stuff is done, but just not unlocked. But to be able to track this a little easier is what I asked the team to do. Anywho, let's pick a euro yen today. Technically, still quite bullish. Hesitation at 180, 170. But notice based on previous price action, there's still potential for up. This is a dip. And you might see like this 69.24. If we bounce at this little zone and right and recover, we could probably get back to 170. Although soon, okay, we're going to roll into downward pressure. So there's a flip to this. There's a flip to this. I don't think I would. Okay, the flip here, let me explain that, is that you're preparing to buy the Japanese yen between June and September. But I wouldn't do this one first because it's so strong. But you could look at this and you'd go through each pair. They have a slight different seasonality, but I think it'll work out generally the same. That from June to July and through August. So for 8 weeks on the 20-year and on the 5-year seasonal average, these pairs tend to fall. The up is now slowly becoming, sometime soon, the down. And that might be something maybe the central bank wants, or maybe it can't stop. But nonetheless, that is what's normal. And that might be part of your alpha, so to speak. You're like, which one? These might be like buy and hold scenarios. Oops. And you could like at least create the thesis that this seasonality goes from a plus one to a negative one, for example. This one usually starts closer to July, but notice how it's less bullish. Okay. And maybe now you go to your charts and say, well, this is the least bullish. Okay. And somewhere, so we're about to start June, is what I'm saying. So somewhere between June and July, this asset typically starts to lose value. Okay. In particular, because it's not really selling Kiwi, but you see how the market is 85.5% short the yen. Well, what if they just take profit for the summer? Let's say that's normal. Then you could start looking for that on your charts now. 4 weeks early. Well, yeah, but you don't know if it's today, next week, 5 weeks, 3 weeks. You don't know. But you could put the plan on your chart and say, well, should I give it a try? That's a thesis. Then you connect that thesis to some technical analysis to say, well, if I was going to trade Kiwi yen to the downside, technical analysis simply tells you, is it the right price and is it the right time? Okay. Now, you could say this looks very bullish, and I certainly won't disagree with you. Okay. Okay. Well, says right away, QuantBox sent you a message about gold, but then you saw a rising wedge and a bearish flag. It doesn't give a damn about that. It's fundamental, Bern, right? It's like it's not looking for rising wedges. It's not analyzing a chart for you. The TRADARS will need to do that. Okay. Yeah. So, but let's go back to this. This is an expected out price. Out. Okay. That's normal. The other things that are important is this top and this top somewhere. We don't know which one. The real body, right? Which is just really a different version of this, or the wick. Okay, great. The another price is this price. Those are all interesting to a bull, not to a bear. Now, let's say you're a smarty pants and you felt like between June and July, you find a top of the market and that the market could fall for 2 or 3 months, a down quarter. Well, QuantBox shows that that's likely. Now, it's so specific. This one says, it'll happen more like July, where the other one's like, oh, it could happen in June, right? But nonetheless, you're looking for all this. And so now you might place a different weight on this technical out. We already know that. This is also, okay, that's a bull out. Okay. This price here is a bear in. So, somewhere along the way, something like this might happen. So, the two things are like, how long are you going to stay a bull? I'm not even talking about you being a bear, but just like, when should you take profit? Okay. Somebody took profit 2 days ago and could be the smartiest smarty pants in the market because they're like, you know what? Give me my money. I'll see you in Miami. I'll see you in September. So burned, it's fundamental, right? That's what it's showing you. So I just showed you two different things. You could have a bias based on the macroeconomics. If QuantBox says bull, you're a bull. That you're done. Now it'll give you 19 reasons why, economically, why gold would be expected to be bullish. That's what a bias is. Now from that, you just trade that. Doesn't mean you just buy it at any price, but as long as it's bullish, let's say, then you're looking at your charts for bullish opportunities. Okay. Just because, like, I buy the stock market. Am I going to buy it today? No. But I own the stock market. And I'm a buyer of the stock market. I'm going to buy it later this year or later this month. I'll buy it next year. I'll buy it 5 years from now. Okay. But it doesn't mean today at this price. So think of QuantBox like that. Like, are like, if somebody asked you, Bernd, what do you think about gold? Well, as long as inflation is above GDP, I'm interested in buying it. but not right that second. Okay. You still have to use your charts, right? But at least you know you're a buyer. So, uh, right. So, QuantBox is bullish on Kiwi yen. That's one way of doing it. Okay. And that's going with what's happening. We call that a trend. Now, every once in a while, I want to be a smarty pants. That's usually not how you make a lot of money. Going with the flow is how, right? But I'm throwing in some seasonality here. And I'm thinking, what is the importance of some of these prices relative to what might happen in the near future? So I could say, should I sell or buy Kiwi yen? Okay. So I go to here, I go to this chart. This shows Kiwi yen has been way up this year, way higher than normal. But somewhere between June and July, this asset comes down over the last 5 years, but also over the last 20 years. Over 20 years, it's more like June, July, right here. In the last 5 years, it's somewhere June, July. So here's what I could do I create a window of opportunity. Okay. So QuantBox might be bullish in general. Okay. But then I could look in here and say, well, there's a window. Okay. Those are supposed to be vertical, right? Really a window between here and here. So between June and let's say August, okay, it's almost certainly going to fall. Almost certainly going to fall. Yeah, maybe this year will be different from the last. It is true. But if I saw, like I showed you on the charts, okay, as we go into June, we're in a bullish out. And then if there's a dip like this, and then you get a bearish in, and then you get a lower low, not only would I sell it, I would hold it to almost October. And that's where QuantBox comes in. You know that if you sold it, let's say, we'll say June 15th is when the bearish pattern showed up, a double top with a lower low, lower high. Okay. That's when the pattern shows up. I'm going to hold it for 2 weeks in June, 5 weeks in July, 4 weeks in August, and probably down to about the third week of September is typically where I'd bail on this. But I also know through experience, it'll probably last until July and then go up. And I discussed this in January that this dip is going to be deferred to November. Wait, what? Yeah, I'm looking at the 20-year average. It's not going to be the third week of September this year. It's going to be closer to the second or third week in November. Okay. So, yeah. So, economically, okay, let's say the yen stays weak and the Kiwi stays the Kiwi, but we also know seasonally this is normal no matter what. So, I can use that knowledge to at least, and think about what's happening. For those that have been long, January, February, March, April, May, June. Okay. What is this peak? Canada Day. I make a big thing about this all the time. Canada Day. Okay. The 1st of July. And what happens? Profit taking. So now I use my charts simply to identify when other people have decided to take their profit and leave. Maybe it's early this year. Maybe it's late this year. I don't know when everyone else is going to do their thing. Now, of course, we have some pretty good information. I guess I should leave it here. We have some pretty good information for you to maybe try to scope all of this out. Okay. Week 23 seems to be pretty good. Okay. Week 23 seems to be pretty good. Okay. But you still open your chart and say, is it now? Well, again, that's a bullish out, not necessarily a bearish in. But if you thought that we could peak, okay, and let me try to get the window in there just right as much as I can. Okay. If you thought somewhere between this right this time, which is the end of May, and this time, which is the end of June, okay, which is way out here. So this is Canada Day. If you thought somewhere in that time horizon this asset would fall, then you would look at this chart differently, wouldn't you? So what if this came down, hit the 21, came all the way back, challenged this, and then started to fall? And it's the third week of June. Okay, this is where QuantBox makes you money. If it did that and you got that right, you're like, I'm not interested in 25 pips profit. I'm not interested in 250 pips profit. I'm going to be short for like 9 weeks or 13 weeks short. That's right, Bernd. Yes. Yes. This is the June bearish target. And that's what I'm showing here, Bernd, right? If you sold a double top here and you're a bear. So I said this is a bullish out and this is a bearish in. Okay, so bulls are taking profit and then bears enter because they have a double top, right? This M3 predicts this price, 90. So that means it's approximately 700 pips down, but only in the first 4 weeks. But I'm talking about being short for like 12 weeks, maybe 16 weeks. 700 pips is scratching the surface. Okay. Because this would essentially be the high for the year. And you're shorting. Why? Because you're a degenerate gambler? No, if you shorted now, you're trading against the technical trend, and QuantBox doesn't want you to do that. But if you got a double top this time of year, QuantBox would point out that it's a 3-month drop. Therefore, not counter trend at all. It would be a seasonal trade. What I'm trying to do is get the randomness out of people's trading, right? So you can break it down and say it's a seasonal play. It's not a counter trend, it's a seasonal play. Okay. And there was a request for gold. Okay, why not? Where I want to look at this. Which one? There's the thing I was talking about with oil. Wink, wink, nudge, nudge. All right. XAU. All right. All right. This chart. Oh, my pleasure. My pleasure. Yeah, I don't like to outsmart the market, but you should know that things are likely based on historical fact. Things are very likely to change soon. So it's like something you could talk about at a dinner with a potential client. And that it'd be interesting information. You're like, you see the risk, you see the change coming before everybody else. Remember, even institutional, professional investors, most of them are like sheep. They're all just doing the same thing, or they're more like zombie robots. They just do the same thing every day. They don't even know what they're doing. They just do it. I don't know why I do it. This is just what we do. So it's more like you can foresee the future a little bit and say, well, I don't, we have the central bank with Japan. We have that. So you can introduce that to the conversation. But you also know what normally has happened over the last 5 years and what normally has happened over the last 20 years. It'd be foolish to ignore that, right? So anyway, so you have that embedded in your analysis and your stories. Now, with gold, is it true inflation is higher than GDP? Yes. So, in periods of higher inflation, is it a reasonable strategy to own gold? Yes. So, if QuantBox throws off a score that is positive, let's say, then that's fine. It says own gold. Great. Now you do your technical analysis. Okay. And is this a bullish trade? Not yet. No. Okay. Not yet. Okay. I think I pointed this out last week too as a sell price. So, anyway, so now we're just farting around and waiting for this to turn bullish. So, is it bullish now? No. Now, someone's going to say, usually when you're a bull, okay, and there are lots of gold bugs, they're going to say this is a double bottom. I'm like, whatever. I don't care. It might be. Nah, probably not, but I don't care. Like, I don't care. But I can be a bull. It's fine because inflation's higher than GDP. Sweet. So what do I need as a bull? Well, I need the 21 to do something like this, which means I will need price to make a test here. Okay. And then it'll probably come down, make a higher low, and then it'll make a higher high, and then it'll make a higher low, and I'll meet you here. Meanwhile, as that's happening, this will flatten out and we will get a 2155 cross. And I will buy it there if QuantBox gives me a positive score. That'll be the right price for me and it'll be the right time for me. Now, Byrne brings up, what everybody else talks about, right? The media, right? There's all kinds of reasons. Oh, yeah, China recovery. Yeah, cool. Well, if you bought on the way down, you lost money because you're not doing technical analysis, right? Like once we broke this, yeah, I don't buy. So now I'm sitting around, and then once this crossed over, still I can't buy. I even highlighted this as a sell zone. So this is technically not a good price or time to buy. But yeah, sure. If I'm buying gold and China's recovering and there's restockpiling assets, sure. And I could probably buy some Aussie dollar. Australia sells gold. They sell iron ore. They sell coal. They sell diamonds. Okay, cool. Yeah. But at this point, like the way I use QuantBox right, well, let's just say QB says, let's just say it says 6 or 5 or 3 or whatever. That just gives me a permission. And if this goes from 3 to 4, and then the next day I change it from 4 to 5, then I feel like I'm becoming more bullish because it's confirming my thoughts. Meanwhile, I just wait, and when I get this, I take the shot because I'm lining up my technicals with my fundamentals. The disaster is when people feel like they have to trade it every day. Okay. And that's wrong. That's not how you do technical analysis. But once you are, let's say you're a bull and you get the higher high, do you buy the higher low? Yeah. And then you get a new higher high. Do you buy the new higher low? Yeah. Especially on a roll reversal. Then you get a new higher high. Do you buy the higher low? Yeah. Especially at a roll reversal. Then you get a new higher high. Do you buy a higher low? Yeah, but the roll reversal is way down here. So it did come down. There was a buy, and then it went up a little bit, and then I connected these wicks. Okay. And now it's making this kind of pattern. Do you buy? No, 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 no. You buy here, you buy here, you buy here. You could have even bought here, and that one failed. So that one you took a loss. This one's a winner. This one's a winner. This one's a winner. And you're sitting around waiting because nothing economically has changed. It's just that all the bulls took profit. Okay. Now, this is a buying price. This is a buying price. And so now I'll sit and wait. And if I get a higher high, I'll buy a higher low and I'll repeat this process. Remember, I did really well in silver, right? Because I did a simple version of that. So now I sit and I wait. Okay, cool. So remember, if QuantBox says something is turned bullish or is more bullish than it was before, that's only fundamentally. Yeah. And then if you zip over to TRADARS, you wait for it to throw off bullish technical signals. And then you have your technicals and your fundamentals aligned. I think you're going to do great. Peace on earth. May the pips be with you. May your profits be above average. And speaking about TRADARS, don't forget we have summer school in less than 2 weeks. Time to get signed up. And this is literally how to pull the trigger. And it's not a lecture series. It's a roll up your sleeves and get your fingernails dirty kind of boot camp. Okay. It's not a lot of money, but it probably will make you a better trader by actually pulling the trigger, simulate. This summer, you might get 5 years of trading experience. Yeah. And fear and hesitation will be removed from your psyche. Peace on earth. May the pips be with you. May your profits be above average. I'll see you soon. Cheers.